Good morning, everybody. That's a first for me to hear that kind of music as I'm coming on to talk about the economy. I think we should always do that. Yes, thank you for the introduction. I am, as Kerry said, I'm going to give you a bit of a whirlwind tour of our views at Capital Economics about how the world economy is looking. And particularly, I'm going to be thinking about the next couple of years. Looking beyond that really is a bit of a stretch. Even for people in our industry. So I'm going to start by talking a bit about the United States, because that still is the key economy and determines so much of the financial conditions overall. And I'm going to then talk about Europe, and I will talk quite a lot about Greece. I guess you'd rather be talking about Greek hotels and the tourist industry in Greece, but unfortunately it seems to be in the headlines for different reasons. Then about the fallout of a Grexit, if it happens, for the rest of the Eurozone. And then I'll finish with a few words about emerging economies. But starting with the United States, the US economy, of course, where the crisis started, is actually probably the first economy that was badly affected by the crisis to have really come out of it. It's almost back to normal, except for the fact that its interest rates are so exceptionally low. If you look at most of the things which caused the crisis and the legacy of the crisis, the negative problems that the US was left with after the crisis, they've mostly been resolved. So, for example, household debt in the United States is down to where it was very early in this century. The budget deficit's right down to just 3%. They don't need any more austerity in the US. The banking sector is very strong, and the housing market has recovered. Looking ahead over the next couple of years, we're expecting the US, I think this is a consensus view, to grow very strongly, perhaps by about 3%, both this year and next. And there are a couple of things in particular which are going to help consumption in the United States. The first is the fall in oil prices, and it's difficult to overemphasize what a big impact the collapse in oil prices has made. It looks as if the new lower oil price is here to stay. It's around about $60 now. I think our forecast is for about $70 within a couple of years. But it seems unlikely that it'll go back above $100 where it had been for several previous years. That's given a huge boost to consumers. Now, the markets and the media tend to focus a lot on the negative impacts because they're concentrated on particular firms and, of course, particular countries. But the positive impacts for a country like the United States and for the world as a whole are larger than the negative impacts for these particular areas. Now, this chart shows how we measure simply the benefit to the US consumer. You can see the fall in the gasoline price on the left-hand axis, and the blue line, which shows how much consumers are spending on gasoline. It follows that very closely, and it's going to collapse from about $380 to $220 billion. So without getting into too much of the numbers, that's a very big impact, worth about 1% of GDP, a lot of which is bound to be spent and boost the economy. The other really big driver of the recovery in the US is the labor market. Employment figures have been very strong over the last 6 months or so in particular. But if we take a step back and look at what's happened to the unemployment rate since 2010, you can see on the red line here that there's been a very steep decline. It's now down to just over 5.5%. And that's almost back into the range which the Federal Reserve Bank would consider to be full employment, and at which point they can begin to think about raising interest rates. One risk that people often point to in the United States and elsewhere is of deflation. Now, of course, that's an issue around the world, but we tend to think in capital economics about there being good deflation and bad deflation. In the case of good deflation, you benefit from cheaper prices, and that gives the economy a boost, but you're not at risk of deflation becoming ingrained and persisting for years, and that's the thing which you need to worry about. In the US, we think that's highly unlikely to happen because although there is going to be a period in which prices are falling, the underlying strength of the economy, the relatively high level of inflation expectations, and the continued support from the Fed all mean that inflation is likely to bounce back. So if you look at the red line here, it goes down below zero for a short period, but by this time next year it should be heading back towards where the Fed would like it to be. The blue line is the core inflation, which excludes energy and some other more volatile products, and that should remain around the 2% level. So it's a country where we're expecting to see good deflation. So the US outlook, in brief, is really pretty strong. Turning to the UK, very briefly, the UK is in many ways rather similar to the US. Its recovery has been much slower, and if you look at where its GDP is or its output is now compared to before the crisis, it's only just a little above its pre-crisis level, whereas the United States has gone well ahead. But if you look in terms of where we're going in the next couple of years and the overall position of the economy now, it's quite similar to that in the States. We think the economy will grow by around 3%. The UK, like the US, should benefit from good deflation. It benefits from lower oil prices. Like the United States, it's a net oil importer, although it has an oil industry of its own. Having said that, there are more risks in the UK than there are in the US. One of them is that the UK still needs to tighten fiscal policy, unlike the United States. This chart shows what's happened to fiscal policy over the last several years. And where the red bars are above the line, that's a fiscal stimulus. Where they're below the line, that's austerity, fiscal squeeze. You can see the previous 3 years we had a lot of austerity. This year, which just happens to be an election year, there's no change in the overall fiscal position. But looking ahead over the next several years, we're heading back to more austerity, regardless of the outcome of the elections. So that could dampen growth a little. There are other risks in the UK, which I might just briefly mention. One is the strength of sterling, which has a bigger effect on the UK economy than the dollar does on the US, because the UK is a much more open economy in terms of how much it trades. Another is the property market. We're not forecasting a fall or a significant correction in UK property, but that is clearly something that could happen. The reason we think it's not likely is that the economy overall is quite strong and the monetary policy is likely to be tightened extremely slowly. They may not even raise rates this year. There is this huge imbalance between the southeast and the rest of the country, but that I think reflects the underlying factors driving the strength of the southeastern part of the economy. But still, there clearly is a risk there. The other risk in the UK is, of course, politics. Elections are due in May. It looks as if there'll be another, what we call a hung parliament, so with no party with overall control. That would be viewed as being slightly problematic or slightly create some uncertainty, but it's certainly not a disaster. We could see further set of elections later in the year. The bigger risk in terms of business confidence, I think, is that there may be, depending on the election outcome, there may be a referendum called perhaps in 2017 or so on our membership of the European Union. And regardless of the pros and cons of EU membership, we've seen before that uncertainty about a referendum can and does lead to weakening business confidence. It was actually really clear if you looked at the Scottish referendum, which we had last September, which is a parallel situation. You could actually see the decline in business confidence ahead of that. So that's a concern that we have. But overall, still, the outlook for the UK is still pretty good. Now, turning to the Eurozone, unfortunately, that's where the good news largely ends. The monetary union clearly has been something of a disaster, whatever you think about the EU as a whole. And I think it's going to continue to cause big problems over the next few years. Yet again, the epicenter of the problem is Greece, so I'm going to say a bit about that. So there has been, are my slides not appearing? Okay, they're there, yes. So there has been a deal struck for the next 4 months, which has really almost no content to it. It's just an agreement that they will keep talking and that some funds will in principle be available. But Greece's finances remain on a knife edge. This chart shows the payments due this year by month to the IMF, those are the red bars, and to the ECB. Those are actually bonds which the ECB owns in July and August. And you can see there's sort of consistent, fairly heavy schedule of payments. The bailout funds are 7 billion euros, which is not enough to finance all of those payments. And moreover, since the election of the Syriza government, the underlying fiscal position, the revenues of the Greek government have gone down. So this pressure on the budget is not going to go away. The other Achilles heel of the Greek economy, apart from the budget, is the banking sector. And you can see here what happened to bank deposits over the last several years. There was a huge decline between 2008 and 2012 or 13, partly because of the collapse in the economy, and also because people became increasingly worried about the stability of the banking sector. But then, perhaps surprisingly, bank deposits were pretty stable between 2012 and early this year, or very end of last year. You do sometimes wonder who it is that's keeping their money in Greek banks and whether they've been reading the news. But what I think is interesting is the very far right-hand side of the chart. You can see quite clearly the deposit outflow, which has happened over the last couple of months. I think it's because of that the rest of the Eurozone was so willing to reach such a weak agreement to keep things afloat a couple of weeks ago. Now, looking ahead, in terms of what happens to Greece itself, I think our current view is that Greece it's about 50-50 whether they stay in the Eurozone over the next year or so. We really don't know. It depends, obviously, on the politics as much as on the economics. But we also think it would be better for the Greek economy in the long run if they were to leave. We've seen enough evidence from other countries around the world, whether it's Southeast Asia or Argentina or Iceland, of economies which have had similar problems. None of them are exactly the same. And the devaluation is really what they need to get the competitiveness back. Of course, there would be disruption, but for Greece itself, it would probably be an improvement. Now, the question is, perhaps bigger question, is what is the risk for the rest of the Eurozone? Now, I think compared to where we were a few years ago, it's fair to say that the risks of contagion are significantly lower, certainly through the financial and economic routes. And I think that is an underlying reason as to why other Eurozone countries might be more willing to contemplate Greece's departure. So this chart shows one measure of the links between the rest of Europe and Greece. It shows the other European banks' exposure to Greece. And you can see that's been slashed over the last few years by 80%. So there's not a huge exposure there anymore. The same is true if you look at the bond markets or equity markets or other measures of investment. So Greece would no longer have a direct impact if it were to leave the Eurozone. The other major reason to be less worried about the impact of a Grexit is that the ECB has set up some backstops which would be available in the event of there being contagion to other countries. One is called the OMTs, which is basically a pledge that they would provide funds and help other countries fund their deficits if they needed to, provided they were in a reform program, a little bit like an IMF for the Eurozone. And the other, of course, is quantitative easing, which was just started this month, several years later than it probably should have been started. But that provides some comfort for markets that a Greek exit would not necessarily lead to contagion immediately everywhere else. You can see that in the prices of bonds. So this chart shows the yield or the borrowing costs for the peripheral countries over the last few years. And you can see the Greek yields began to rise really when the political situation there changed towards the end of last year. But whereas in previous years, a rise in Greek yields had led directly to a rise in yields in Spain and Italy and other peripheral countries, this time that hasn't happened. They've actually carried on falling. So it's quite clear that the markets feel that the risks are fairly low of contagion. Our view is that's a bit complacent. There are risks there. There are long-term risks to the economy throughout much of the Eurozone related to the high levels of debt and very low levels of inflation. And there's also a political risk. I think that's what the Greek situation has underlined. that if you push austerity too far, there comes a point at which you might trigger a reaction politically, and that obviously there's a growth of similar parties in Spain, the Podemos, I don't know how to pronounce that, but in Spain and elsewhere. And okay, they don't look as if they're likely to win the election this year outright, but that could happen. But moreover, if you're looking over a longer period, next to say 3 or 4 years, that's a major risk for Spain, for Italy, and perhaps for other countries. The other risk in the Eurozone is of deflation. And here I think, going back to the distinction between good and bad deflation, the Eurozone is likely to experience, or a much greater risk of, bad deflation. That is deflation which lingers and continues for years in the way that it has done in Japan. And the problem with that, I mean, of course, lower prices is nice for consumers in one way, but the problem is if it continues, then it becomes harder for governments and for companies and individuals to pay down their debts. And of course, much of Europe has a lot of debt. So deflation is potentially a big problem. The oil price fall is what's caused the headline inflation rate to come down below zero recently. But even before that happened, inflation was already very low. We have very high levels of unemployment, and all the other underlying forces that could cause inflation or deflation all point towards a risk of deflation. Plus, these numbers show you the inflation rate for the whole region. If you look at it just for Spain, it's been negative for quite a long time, and not just because of the oil price fall. So that is a major concern about the outlook for the longer term. There is, of course, this new policy, quantitative easing, which should have been launched this week. It was announced at the end of January. The bond purchases are supposed to have started in March. That is designed to head off the risk of deflation. The anticipation of it has already had some effect, I think, in pushing down the euro. Plus, QE does act as a backstop, as I mentioned, for limiting the risks of contagion. But if you look at what QE has done elsewhere, it hasn't had really powerful effects in boosting inflation or growth in the United States or UK or Japan. It's been most useful during a crisis. Afterwards, it's not really as effective as people hoped it would be. Now, I'm going to turn briefly to emerging economies. Obviously, that's an enormous range. Most countries in the world are categorized as emerging. I can't do it justice here, so I'll stick, as is traditional, to the 4 BRICS and talk a little about each of them. So for the emerging world as a whole, there has been a significant slowdown since the crisis, and you can see that here. The red bars show the growth rates of the BRICS in 2007. The blue bars show how much they'd fallen by 2014. That slowdown, I think, is here to stay, but it's not necessarily always a bad thing. It's a big problem for Russia and Brazil, but much less so for China. So I talk about China a little bit. China was growing very, very rapidly, and it became clear over the last few years it was far too dependent on investment, which reached a level I've never seen. I don't think has been seen in any other major economy through history, which is investment was half of the entire economy, and credit growth was far too rapid, which I think you can see on the next chart. So they were propping up growth through huge amounts of lending for big infrastructure projects, many of which were not likely to be profitable. So some slowdown in China has been a positive thing. Later this week, the Communist Party's annual conference, they're likely to announce their growth target for this year, which we expect to be around 7%. They've started saying it's approximate numbers. That we think is much more healthy for China, and they'll probably hit that target. The question is whether there are bigger risks of a much sharper slowdown, and we think those risks are not as great as people often suggest that they are. The Chinese economy and Chinese state still has a lot of headroom to deal with problems in its banking sector if they need to. And the underlying growth rate is still strong enough, the levels of competitiveness are high enough. So we see China is continuing to grow very rapidly, but it's not as rapidly as it was in the previous decade. Turning to India, India, we think, has potential to grow more rapidly than China over the next 5 or 10 years, largely because it's still a much poorer economy with a lot more catch-up potential. The recent developments there have been reasonably encouraging as well. They had an election last spring which brought in a party, BJP party, which had, crucially, a full majority in the lower house of Parliament. That's the first time that's happened for a very long time. And they are somewhat more committed than the Congress party to economic reforms. They're not a Thatcherite pro-market reform party. I can't imagine such a party ever ruling in India. But they are going to push forward some reforms. They have made a few gestures in that direction. And India has also benefited hugely from the fall in oil prices. They don't produce much oil. They're dependent on it. They use a lot of imported oil. And that's helped their current account balance and their budget balance. The other two BRICS we're less optimistic about. Brazil like China, was relying too heavily on credit growth to keep its growth rate up. But in Brazil's case, it was all consumer credit. And the previous government, it's the same leader, Dilma Rousseff, but her previous administration implemented quite a lot of relatively populist measures, supporting welfare payments and regulating prices, using a lot the development bank, BNDES, to finance projects excessively. Now, the new administration has a new finance minister who has begun to rein back some of these areas where we think spending has been excessive. So that's a positive start. But Brazil needs much deeper reforms if it's to get to a higher growth trajectory. So we see growth there recovering to about 2% or so over the next couple of years. It's all in the same league as India or China. Finally, Russia. There's very little positive to say about Russia, unfortunately. This slide shows some of our estimates of the impact of the two major external shocks which have hit them over the last year and a bit. The first being the Ukraine crisis and then the associated sanctions. There's always been a lot of capital flight from Russia, but the capital flight has increased a lot. And the second, even bigger shock was the collapse in oil prices, and then gas prices likely to come down in line with that. That then triggered a collapse in the ruble, rise in inflation, hike in interest rates. It's a familiar story, and it's one from which we think that Russia is unlikely to make a strong recovery. In fact, if you look at this next chart, you can see that on one previous occasion, Russia had a similar collapse back in 1998, which is the blue bar on the left-hand side of the chart. And after that, it did make a very strong recovery. But the conditions then were very different. For one thing, the oil price rose very sharply. For another, Russia was just coming out of the post-Soviet reforms. There was a huge amount of spare capacity in the economy and a lot of scope for catch-up. There now is much less spare capacity. Years of failing to reform and innovate and invest means that we think the underlying growth potential is much, much lower. It's more likely that Russia is in for a period which, economically speaking, would be comparable to the Brezhnev years rather than the first decade of this century. So that's a brief summary of the 4 BRICS. But maybe I'll leave you with the chart showing our growth projections for the next couple of years. So world growth is probably going to stay around the same. We're thinking 3.5%. But there are huge divergences, and that's been a trend or the theme of a lot of our research and a lot of financial market commentary for a long time. And if anything, those divergences are likely to increase over the next couple of years. So that's all I have. So thank you very much for listening. I don't know quite what happens now. If there's time, I'm very happy to take some questions.
Should we do any questions?
ABA. Why are we talking so much about Greece? I think they account for about 0.3% of the world economy and less than 2% of the European economy.
Yes, Greece is certainly very small, but I think we did learn from both the Thai baht crisis in 1997 that a small country like Thailand can trigger a domino effect that has huge implications for the world as a whole. The Lehman's crisis, Lehman Brothers was an investment bank, not the biggest investment bank. So small countries can trigger large chain reactions. I think had Greece left the Eurozone in 2011 or 12, that certainly would have happened. There would have been a wave of problems throughout South Europe. But as I was saying, I think the risks are much, much lower now than they were then.
Please.
Thank you. Apart from the growth that we are seeing in the economy and the numbers and so, are there any fundamental structural shifts that you're noticing? We have the whole Islamic part of the world that's acting up. Are you seeing anything else happening that we need to be concerned about? Thank you.
It's a good question, because it's a very broad question. As you referred to the Islamic world, I don't know whether you perhaps had in mind political risks. It's certainly something that we monitor, or geopolitical risks. So on that front, it's actually interesting, I think, how quite a lot of major geopolitical events, how little effect they have on the economy. So if you look back to 9/11, for example, there's probably not been such a seismic event politically since the Berlin Wall came down, perhaps. And yet, the US economy was in recession early in 2001 after the dot-com crisis. 9/11 happened in September that year. The fourth quarter of 2001, the US economy began to grow again. If you look at the next several years, it grew very rapidly. So the relationship between geopolitical events and the economy is not straightforward. There has to be some vector, something that causes the politics to create financial and economic problems. When we've looked around the world and sort of listed the big political risks for this year, we've acknowledged that there are much bigger conflicts in the Middle East and also Ukraine, Russia, than there are in the developed world. But what we thought were the biggest political risks were those in the Eurozone in terms of the potential impact on financial markets and growth.
Time for one more question up front.
We are listening in this conference to investment firms. They say that in the last 100 years was not so much money coming into Europe like in this year, over 800 billion euro coming to invest in Europe. The hotel industry is reporting booming, and like many years ago, they didn't see such a good business in the hotel industry. When the hospitality is good, business is good. Why your projections on Europe are so pessimistic, so negative, when everybody sees big growth in Europe? How can you treat Europe all in one word? It's not like one country. China.
Yeah. No, it's a fair point.
Contradiction what you say to what we hear yesterday.
It tends to be the job of the economist to be gloomy, that's one thing. So I apologise if that's how it comes across. I don't think we're completely gloomy about the Eurozone. Part of the issue is that the Eurozone is a very advanced economy, and its potential growth rate is lower than that in emerging economies, just because of the potential for catch-up and technological advance. So comparing the Eurozone to China would not be completely reasonable. Comparing it even to the US is not a direct comparison either, because the population growth, or the population of working age, is not growing as quickly in the Eurozone. So if we looked at the per capita numbers, they wouldn't be as gloomy. And within the Eurozone, you're absolutely right, there are some economies which are obviously growing much faster than others. Nonetheless, the overall average GDP growth figure is not going to be higher than perhaps 1.5% or so this year, we don't think. And our forecast of 1% growth is a little bit below the consensus, but it's not dramatically so. And there are obviously some parts of the Eurozone, Italy, for example. I have no idea what the hotel business in Italy is like. It may be doing very well, but the Italian economy is basically more or less stagnant. And that's a fairly big part of the Eurozone. So yeah, it's an average. Some parts are booming.
So it would be an average of the economies, right? But also, given the focus of this industry, there are industries that are growing more rapidly than others as well.
Certainly are, yes.
Right.
I have to say, hold my hands up, I'm the macro guy, and I'm not the expert on that, but clearly there are some industries which grow very well in an overall stagnant economy as well.
But I think for the gentleman's question,
Yeah.
I think the question that you had was why the contrast between what you saw yesterday and what you heard about yesterday, which was tremendous growth within hotel investment on the one hand, and the counterbalance of a broader economic perspective today, and I think that's probably where the answer lies. So, well, Andrew, thank you so much.
No,
actually,
thank you.
Yeah. You've mission accomplished in terms of giving us the dashboard and the radar.
Thank you.
Thank you so much.
Very much.